So thanks everyone for attending earlier this afternoon. I'm sorry about the technical problems that we had. So obviously we're now downloading this webinar remotely. I will be happy to pick up questions by email. Please do send them on to Chloe. Okay, so how I'm going to cover this talk. First of all, just be a brief introduction. What is an employee ownership trust? Secondly, as people will be aware, an employee ownership trust qualifies for tax reliefs. The second point will be what conditions do you need to meet to qualify for the reliefs? The third point will be how, in practical terms, can a company be sold into an employee ownership trust? And the fourth point will be, once a company has been sold into an employee ownership trust, how is it actually run in practice? How does the governance work? And then questions, as I've said, I'll be happy to pick up by email afterwards. What is an EOT? As the slide says, it's a discretionary trust which is set up to hold shares in a company and importantly to hold them for the benefit of all the company's employees. Under a structure of this type, you would have a trustee company owning the shares in a trading company or group, but crucially the trustee would have to use its shareholder powers for the benefit of all the group's employees, subject to some exceptions. Now, structures like this have been around for a while, but tax reliefs for them were introduced in 2014 under the Tory Lib Dem coalition. Why were the tax reliefs introduced? What's the point of all this? Well, it was all about, and a phrase that was used at the time was injecting employee ownership into the lifeblood of the UK economy. So there's a view that employee-owned companies do better because the employees are happier, they're more engaged, if they own a stake in the business. So the idea behind introducing reliefs in 2014 was we think companies of this type are good for the economy, so we will offer company shareholders a tax break to sell into structures like this. And obviously the most famous example of an employee ownership trust owned company is John Lewis and Partners, but there are several others. Now, what are these tax reliefs? The headline one, and this is particularly relevant at the moment with talk about changes in tax rates, is that you can sell your company into an employee ownership trust structure free of capital gains tax. Unlike entrepreneurs relief, or as it's now called business asset disposal relief, the relief is completely uncapped. There's no limit on the value of a company that can be sold in tax-free, and you're seeing companies that are worth 80 or over 100 million going into these structures. A quick point to be aware of for later, which is the way the relief works is that when you sell into an employee ownership trust, any capital gain on the shares isn't taxed at that point, but it doesn't just disappear entirely. It gets passed on to the trustee of the employee ownership trust, and that will be relevant later. A second tax break that you get within these structures is that bonuses of up to 3,600 per year can be paid to employees of EOT-owned companies. Inheritance tax reliefs, really, there's nothing special on offer here. It's just that you need some tax breaks to be able to sell in free of inheritance tax, essentially. So no unwanted surprises. So why sell into an EOT? The obvious reason at the moment is because it's tax-free. Particularly with the restriction on business asset disposal relief, particularly with the talk of capital gains tax rates going up in the future. But the types of companies that have been sold into structures like this, the business owners generally aren't only tax motivated, and with some exceptions, of course. Generally, the companies that go into this structure, you do see some buy-in to the concept of employee ownership. People generally don't just want to benefit from the tax breaks, they do actually like the concept as well. And some of the intended benefits are set out there. So greater employee engagement, higher retention rates, lower absenteeism, and higher productivity. In practice, the structure is also relevant for businesses where you've got difficulty finding a third-party buyer, and sometimes there are all sorts of businesses that sell in. It's not limited to a particular type of business. Sometimes there are types of business which are difficult to sell, also types of business which are quite people heavy. So something like an architect's firm, for example, where the main asset is the employees, are probably overrepresented in the companies that have sold into an EOT. I've got to say something about change of law with what everyone will have seen in the press at the moment. Clearly, there's a lot of uncertainty at the moment. I mean, I don't have any crystal ball about what's going to happen. I can just make a few points. So one point is just that a simple and easy change that they could make in the autumn budget is to increase capital gains tax rates. Now that change of itself wouldn't affect EOTs, because EOTs do have an exemption from capital gains tax. So they would probably need to do something more than just a tweak in rates to remove this relief. It's possible that they could cap it. So like with entrepreneurs relief, stroke business asset disposal relief, as it's now called, they originally had a limit of 10 million and they moved that down to 1 million. That could easily happen here. They could even abolish it entirely. Hopefully they won't, or at least not in this budget. I mean, I could be wrong, but I'm reasonably optimistic that there won't be anything too radical happening to EOTs in the present budget. So, and that will come out around October, November this year. That could, of course, be wrong. But then even if there isn't an immediate change in law, I mean, you do have to wonder over the sort of medium term, with all the funding the government needs for the COVID job retention scheme and other matters, something with a 0% tax rate may not last forever, unfortunately. If people are very worried about change of law, I suppose the only and we are seeing clients who are just looking to move into these structures immediately. I mean, to do it with no risk at all, you'd need to do it before the budget, which is obviously October, November this year. Not everyone is sort of rushing to sell into these structures, but probably if you were thinking about it, it would be sensible to do it over the next couple of years at least, and maybe even earlier. Qualifying conditions. So I'm simplifying this a little bit. The qualifying conditions are very complex, but I mean the key question here is this exemption from capital gains tax and an exemption from income tax for the employees. What do you need to do to qualify for it? So a simplified version is there are 4 key requirements. So trading requirement, quality requirement, controlling interest requirement, and limited participation requirement. So the trading requirement, I mean, whether a company is trading or not is a sort of known tax concept. You have to be a trading company to do this. I mean, what does trading company mean? I mean, there's lots of tax case law and what it means, and I don't want to go into the detail, but broadly speaking, we're talking about active businesses such as a shop or a business that makes something, rather than a passive business, the key example of which would be something like a company with a buy-to-let portfolio or commercial property investments, where essentially you just hold an asset and receive the returns from that asset. I mean, a property investment company would not be a trading business and could not qualify to be sold into an EOT. The equality requirement. So this goes to the heart of what EOTs are all about. So you sell your company to an EOT, so a trust for the benefit of all the employees. Then what are the terms of the trust? I mean, broadly, the trust becomes the new shareholder of the company. So we're talking about what does it do with dividends that it gets up from the company, and it has to apply those dividends for the benefit of all eligible employees. More on that later. But broadly, the trust becomes the new shareholder, and it's got to use shareholder money, such as dividends, for the benefit of everyone, not just for a few people. An important distinction to make is that requirement does apply to shareholder returns. So dividends that you get or money from perhaps selling the company at a later date, it doesn't apply to salaries paid by the company itself. It applies to what the shareholder's getting. So with salaries, you can do pretty much what you like. There isn't any salary requirement here. The requirements only apply to what's happening at shareholder level. And a point there, I mean, we're coming on later to how to actually get into a structure like this, but a practical point is that the current shareholders are going to need to sell into the structure, and they will need to be paid off before any new shareholders get anything. So this wouldn't be relevant for a few years anyway. What does an eligible employee mean? It means anyone who's an employee of the company, but broadly speaking, except for the people who've sold the company into the EOT in the first place. So other than current and previous 5% shareholders. Now, I say the trust's got to be for the benefit of all the employees. There is some relaxation of that. You don't have to say everyone gets the same. You can distinguish between employees based on remuneration. So higher paid employees can get more of the shareholder level returns as well. Length of service, or obviously the longer you can give longer serving employees a bigger entitlement, and hours worked. So part-time employees can get less. Apart from those three factors, you cannot differentiate between employees at all. Apart from differentiating on those three factors, they've all got to get the same shareholder returns. Controlling interest requirements. So the key point here is to get these reliefs, you've got to give up control of your company. You've got to sell in an interest of over 50%. You don't get the tax breaks, but still keep ownership of the company. It does leave, let's say, 49% of the equity to play around with. I mean, either for the existing shareholders to retain, or perhaps to use as some sort of employee incentive for new shareholders or for key employees in the future. The relief looks at whether the EOT gets a controlling interest. It doesn't look at the seller, so it just looks at whether the EOT gets a controlling interest. So for example, if the EOT does get a controlling interest in one tax year, then anyone who's selling in during that tax year can get the tax-free treatment. So for example, if you've got one person with 51% and then various other people with 10% each, if in the tax year in which the EOT gets control, even the people with 10% can get the tax-free treatment. It's not just the controlling shareholder who qualifies for tax-free treatment. So effectively on that example, other people can piggyback off the main shareholder and themselves get a capital gains tax exemption. And the 50% requirement applies to 50% of the shares and 50% of the profits available for distribution and 50% of the assets on a winding up. Limited participation requirement. So very simply, you can't do this if you are, let's say, a company with a small number of shareholders who are also employees. So for example, a company with 4 employees and they each own 25% of the shares. That won't qualify. And broadly, the point of that is they're looking at companies with, let's say, 1 or more main shareholders and a large group of employees, and indirect ownership is passed to the large group of employees. But you don't get the relief where the ratio of employee shareholders to total employees is greater than 2 to 5. So they want to see lots and lots of employees who aren't currently shareholders getting indirect ownership of the business. But it does work according to that strict fraction. Like I said earlier, the trustee of the EOT potentially inherits the tax base cost of the people selling in. So when you sell into the structure, you don't pay tax. But if the trustee subsequently sells on, it could have to pay. It could then be liable for the tax that you sort of should have paid on the way in. There is a way around that, which is to use a non-resident trustee. And that does carry higher costs, but the point there would be pass the taxable gain onto someone who's non-resident and isn't themselves liable for tax. So pass a gain onto someone who won't pay tax on it. A bit more on that later. And then very simply, the next slide. So you've got all these conditions to meet. what you can't do is sort of meet them at the point you sell into the EOT and then suddenly start breaking all the conditions once you're within the EOT structure. So if you do that within a year of selling in, then the people who've sold in lose their capital gains tax exemption. If you do it after a year, the people who've sold in retain their exemption, but there's a potential tax liability for the trust. So that's just common sense, I think. And again, just very, very briefly on the 3,600 bonus, employees can get up to 3,600 a year tax-free. And again, you can set the amount of the bonus anywhere up to that, and you can differentiate between different employees based on, again, salary, length of service, or hours worked. All employees with at least 12 months service have to be eligible to participate. One point to watch out for is you can't do it as a salary sacrifice. So if you've got someone on 23,600 a year, you can't just reduce them down to 20,000 and then just pay them the extra 3,600 on top tax-free. That unfortunately doesn't work. Okay, so that's a quick idea of what an employee ownership trust looks like, what conditions you have to meet to qualify for tax relief. How in practice do you get into one of these structures? Well, is where is the EOT going to get the money from to buy the company? And the first answer to that question is it can self-fund. So, and that's shown by the picture here. So let's say that we've got a company making trading profits. The company is sold into the EOT on day one. The EOT obviously doesn't have the money, but what you would do is maybe spread the purchase price over about somewhere between 5 and 10 years, depending on how profitable the company is, and it will be paid off in tranches. And what would happen is the company would hopefully carry on making trading profits in the same way. The profits would be subject to corporation tax in the normal way, but the money would go from the company to the EOT tax-free after the corporation tax, and then from the EOT to the selling shareholders, again, completely tax-free. What's important there is that, I mean, since the selling shareholders are being paid off over, let's say, 5 years, they would want to know that the company is going to be good for the money. So they may want to stick around for 5 years or so to make sure that the business is run well. And they may want, for example, to put something like an employee incentive in place to make sure that senior management are incentivized to pay them off, to make sure they get paid off. The second option is essentially just take out a bank loan, and that also works. And the funds flow here is the company borrows a chunk of money from the bank. Of course, the bank is not going to lend at 100% LTV, so this would need to be combined with trading profits being used to pay the selling shareholders. But the day one tranche goes into the company, and again, it can go up to the EOT tax-free and out to the selling shareholders, again tax-free. And I should say, with either structure, if you do this before they potentially change CGT rates, even if some of the consideration is payable in tranches, the CGT exemption would be preserved, provided, of course, they haven't abolished it by the time you sell in. So if you sell in on day one with consideration over a 5-year period, it shouldn't matter if they change the rules on CGT during those 5 years. Of course, the upside of this approach is you get more of your money up front. Of course, the downside is that the bank here is going to demand a return on its loan, which would have to be paid. Some practical issues. So company valuation. So this is a real hot topic. So you cannot sell into one of these structures for an amount that's greater than your company is actually worth. And broadly, 2 things would go wrong if you did that. So first of all, it would probably be a breach of trust by the trustees. So the EOT, the trust that's set up to own the company, is supposed to act in the best interests of the employees, and overpaying the selling shareholders would not be consistent with that. And then secondly, something would go wrong from a tax perspective, which is there's a rule which says that if you sell your company for more than it's actually worth, and if assuming you're an employee or director, you just have to pay income tax rather than capital gains tax on the excess consideration, so the excess over market value. And you do see a really wide variety of approaches that are taken here in practice. So one famous employee-owned company is Arup, the architecture firm. Mr. Arup himself actually sold into an employee ownership trust for nothing. He just gifted this very valuable company in simply because he bought into the employee ownership concept. He really liked it. And since then, the company's really flourished. He didn't want anything for himself. At the other end of the spectrum, you get people who definitely aren't taking that approach and want to get the absolute maximum possible value for themselves. We even had one guy who was asking multiple valuers for a company valuation, and essentially he would just go with whoever would give him the highest valuation for his company. I think because of this overpayment point, you generally wouldn't want to do this without a professional valuation, because it would expose people to risks if you didn't have a valuation to back up the price you're going with. I mean, going back a slide, if people did want to get the maximum amount possible for the company, the point I would make is you can get what the company's worth as the sale price. I mean, if the selling shareholders on the slide there do want to continue working for the company while their debt is being paid off, they absolutely can. And furthermore, they can be paid for their work in a way that's proportionate to their probably very senior role. So if we're talking about the sole shareholder and CEO of the company, they can be paid a capital sum for selling the company, but in addition to that, they can be paid a CEO salary going forwards. I mean, again, if that individual is ultimately running the EOTs, they would have to be careful to set the salary at a reasonable level. So not just overpay themselves to take out as much value as possible from the company. But at the same time, if someone is carrying out a CEO role, then it's perfectly reasonable for them to get a salary that's proportionate to that. I mean, of course, the amount that you get for selling the company is going to be tax-free, whereas any CEO salary that you get is obviously just going to be subject to income tax and NI in the normal way. Transaction costs. So I think a practical advantage of this is, I mean, when you're selling your company in the market to a trade buyer, or let's say a private equity fund, that can be a long and drawn out process and a very expensive process. I mean, you may have to pay a corporate finance firm to line up a buyer for you. You would have to pay some lawyers to draft your sale documentation. There would perhaps be extensive negotiation of the docs. There would be a due diligence exercise. You do have those sorts of costs with an EOT, but to a much lower level. So the trustee is, you can't just sort of set a deal that would look completely unreasonable in the open market. So the trustee does have to take proper care on buying the company. And it does have to get market protections for itself, so things like a tax indemnity to protect against unexpected liabilities. But the process will be a whole lot smoother than with a third-party buyer. So for example, if you think about due diligence with a third party, they will send their lists of questions. That would be quite artificial when the people behind the trust are, let's say, the same people who are selling up. They'd kind of be asking questions of themselves about their own company. It's just a bit artificial. So while the trustee does need to act in an arm's length way, obviously that is going to be a lot easier when it's a kind of internal friendly purchaser compared to a third party purchaser. And transaction costs will inevitably be significantly lower with an EOT. And like I said, what protection should an EOT trustee obtain? You do have to act in an arm's length way, You have to get market standard warranties, tax indemnity, that sort of thing, but it will be a lot easier in practice. Governance. So this is one of the most closely negotiated things about an EOT. So it might be easiest to go, well, I think I'll stick with this slide. So what I said earlier is that the people who are, let's say, the current shareholders of the company can also, if they want, be the people controlling the trust. But with the key caveat that when they're controlling the trust, so the EOT, which owns the company in the future, they can't do that for their own benefit. They've got to do it for the benefit of all the employees. And there is a potential conflict of interest there. So suppose one individual owns a company, they sell into an employee ownership trust structure, but they also decide to act as the trustee of the EOT, which they're perfectly entitled to do. I mean, there might be a temptation for that individual, if they were, let's say, unscrupulous, just to kind of run the business in a very aggressive way for a few years and basically just get themselves paid off. So they'll be selling to the EOT, perhaps for a debt left outstanding, and just do anything that is necessary to get themselves paid off, even if that's to the long-term detriment of the business. So that's where the potential conflict of interest point comes in. And there are different ways of managing that. So I think one way, now, when we're talking about an EOT, it's an entity that replaces the current shareholders of the company. So it has ultimate control of the company. I mean, the board of directors can carry on being the same people. They'll be subject to oversight from the shareholder. The shareholder can remove the directors if it sees fit. But what if the shareholder, the trustee, does something that is in conflict of interest, or perhaps even breaches its responsibilities as a trustee? Perhaps the individuals sort of decide to favour themselves too much. It probably is advisable to have a mechanism in there to be able to remove people as trustees if they do breach their trustee duties. I mean, what happens in practice is the people who are currently shareholders generally want to carry on running the company to the extent they can. But it's probably, as much to protect them as anything, it's probably advisable to have a mechanism in there just to say if there is a conflict of interest, there is a mechanism to remove them as trustees. That would generally be a very, very limited mechanism. So you'd set a test saying something like if a legal opinion is obtained that the trustees have acted in breach of trust, they can then be removed. But subject to that, and the governance can essentially be very similar to what it was before the company sold into the EOT. There are other ways of dealing with the governance. So the way the government was initially envisaging this was that you would maybe have something called an employee council, which would have representatives of employees, let's say on the board of directors, and they would also have representation at shareholder level, and perhaps they would also even have the power to change the trustee of the trust, which is a really key power because the trust ultimately exercises shareholder level control. In practice, selling shareholders often don't want to do that. They don't want to be subject to the control of people who previously were their employees, stretching back however many years. So that's not practically a very popular way of doing it in my experience. Another potential way of doing it is actually to sell into an offshore trust and just give it a professional trustee. So just an arm's length party that fulfills the trustee function for you. And there are trustees who are prepared to do that. I mean, as I mentioned earlier, the way this relief works is you sell into the EOT, any capital gain on your shares doesn't just disappear, it just gets passed on to the EOT, and you can actually pass it on to an offshore trustee who isn't themselves subject to tax. And then in turn, that trustee could potentially sell the business on tax-free. So offshore trustees are particularly popular where there's a possibility of an onward sale. I mean, generally the idea behind, well, the government's idea behind this is that employee ownership is just so wonderful that once you've sold into an EOT, you're going to want to stay in an EOT structure forever. You're never going to want to sell out of the EOT. In practice, onward sales do sometimes happen, and where there's a possibility of an onward sale, you might use an offshore trustee, which, I mean, as set out here, might also help with the governance of the business. So, I mean, that's what the governance might look like with a UK structure. So you've got the individuals at the top, and let's just say these are the same individuals who've sold the company to the EOT. They can carry on being directors of the company, although of course being directors only gives them quite limited control, because the real control is with the shareholder, because obviously the shareholder can remove the directors if they see fit. So the shareholder is, let's say, a company, and the company acts as trustee for all the employees, and then these same individuals can be the members of the company and the directors of the company. Like I said, it would perhaps, so ultimately they control the trustee company, and then the trustee company in turn controls the business that's been sold in. Like I said, it might be prudent to have some sort of mechanism to remove those powers, only very limited, and only if they really misbehave, which you would expect would not happen in practice if the thing is properly run. But there is a potential conflict of interest for them. With an offshore structure, those same individuals, they can again carry on being directors of the company. Again, you've got the EOT as the shareholder, but this time you've got some offshore professional trustees behind the EOT. I mean, again, in practice, the professional trustees, they would properly fulfill their shareholder functions, but it's again, unless something quite radical happens, then the current directors would probably carry on as directors. And that's it really. So with the unfortunate technical problems that we've had, I can't field questions straight away. But I did, I mean, as mentioned, be more than happy to field questions by email. And I did actually send Chloe some examples of common questions that have been asked on talks like this in the past. So Chloe, I wonder if you'd like to share those questions.
Thanks, John. So one of the questions we've had through is from one of the attendees, Phil, who's dropped me an email, who said, what are the main differences between an EOT and an EMI share option scheme, which he already has in place for his employees?
Okay, so the absolute main difference here is that they're doing different things. So an EMI is an incentive for employees or possibly senior management of the company, but not really for the main controlling shareholders. It's for people who are a level down from the main shareholders. And an EMI can potentially offer them a 10% tax rate on a sale. The EOT structure isn't for the employees or senior management, it's for people who own the company. And those company owners can, rather than selling their company in the market, they can sell into this EOT structure tax-free. So I think that is the main difference.
Okay, one of the other questions, if I sell to an employee ownership trust now, am I protected against future increases in tax rates?
Essentially, yes, you are. So I covered this in the talk. This year's budget will be in October or possibly November. If you sell in before then, and it is a bit of a stretch, your 0% tax rate would be locked in. It couldn't be changed, no matter how you structure it. That is obviously quite a large decision to have to make pretty quickly if you are worried about increases in CGT rates. My personal view is that I think the relief will be retained in some form post-October or November, and possibly even completely unchanged. It's not impossible, however, even if they leave it alone in the autumn budget, they could do something about it within the next 2 or 3 years. So I'd say if you are thinking about this, it might be prudent to start moving it forward sooner rather than later. I mean, the things like the job retention scheme and so on need to be paid for somehow. So something with a 0% tax rate on it might not last forever.
And what sort of take-up of employee ownership trusts are you seeing currently?
So I've personally been involved in about 25 of them since the relief was introduced, and it came in 2014. And during the first year, 2 years, not many people did them because nobody really knew about it. So that has increased over the last few years. We are seeing lots of queries at the moment, and they are being driven by people worried about future increases in CGT rates.
And is there a particular type of business which is best suited to an employee ownership trust?
I think any type of business can do it. I mean, provided, as I said earlier, they're a trading business, so not a passive business like property investment. And we've seen all sorts of business do them. There are some types of business which are probably a bit overrepresented. And I would say those are businesses which are people heavy. So like a firm of architects, for example, or businesses which are difficult to sell in the open market. So I've seen, and to take one extreme example, I've seen a very unusual business, which was a business which made food for pet lizards and pet snakes. It's not the sort of business that you'd normally be looking to buy. So it was difficult to find a buyer for that. And so it was sold into an EOT.
Fantastic. Well, thanks, John. As John mentioned, if you do have any questions for him, then you can submit them via email. John, did you have a slide with your email address on it after?
Yes, I do. Yes, I do.
Here we go. So, John, thank you for joining us, and thank you for re-recording this for us and for the attendees. Do you have any final words before we sign off?
No, nothing more to add, save that just to apologise again for the technical issues that we had. And if you do send questions to my email address there, I'd be more than happy to answer them.
Fantastic. Thank you very much, John.
Okay, thank you, Chloe.